In this video, I will show you the most important moving average secrets that I learned in the past 13 years of trading. Most people would charge for this type of information, but I will give it away for free for reasons that will become clear by the end of the video. You will learn the best properties of moving averages as well as their most critical flaws. Hopefully that will help you avoid the many pitfalls associated with this indicator and also to extract the maximum utility from it if you decide to use it somehow in your trading. So without further ado, let's move on to the first secret about moving averages. Secret number 1, the lag noise trade-off. If you ever traded using moving averages, you must have noticed that some moving averages respond quickly to price changes, and others are slow and take a while to respond when price changes direction. This is of course related to the MA period. The smaller the period, the quicker the moving average responds to changes in price action. By the same token, the larger the period, the slower the moving average response is, meaning that the larger the period, the more lag a moving average has. Another property to notice is that the shorter the MA period, the noisier it is, and the larger the MA period, the smoother it is. These pieces of information form the lag noise trade-off in moving averages. Whenever you decrease the MA period, you get a faster MA, but you also get a noisier MA. Depending on what type of moving average strategy you use, a noisy MA can generate too many false signals. Whenever you increase the MA period, you get a smoother MA, but you also get a lot more lag. The lag noise trade-off is this property that whenever you decrease the noise in a moving average, you increase its lag. One of the problems with this is that if you want to trade moving averages by following their direction, you need an MA that has low lag and low noise at the same time. However, due to the lag noise trade-off, you have to choose if you want low lag or low noise. Both simultaneously is a difficult thing to accomplish. The lag noise trade-off means that it's very difficult to trade moving averages by simply following their direction. If you use a fast moving average, it will respond quickly to price changes, but it will also be noisy, which will create several false signals. If you use a slow moving average, it will be a lot smoother, but it will also have a lot more lag, which will make it impossible to catch reversals in their beginning stages. It's easy to grasp the lag noise trade-off by simply looking at a chart that has a fast and a slow moving average. In this chart, the black line is a 5-period simple moving average, and the red line is a 50-period simple moving average. We can clearly see here that the black line is much noisier and faster, while the red line is much smoother and lagging. It takes more price action to make the red MA change direction, and since it incorporates more price information than the fast MA, there is less noise. Ideally, we want the speed of the fast MA with the smoothness of the slow MA, but due to the lag noise trade-off, this is not possible to achieve. We can reduce the effect of the lag noise trade-off using some simple mathematical tricks, but we can never eliminate it completely. Secret number 2, best moving average type. If you have been trading for a while, you probably know that there are countless types of moving averages. Most of them are a vain attempt to tweak the mathematics of MAs in order to solve this problem of the lag noise trade-off. From my experience, there's only one type of moving average that actually manages to reduce the problem of the lag noise trade-off a little bit, and it's called the whole moving average. Keep in mind that it doesn't solve the problem entirely. It just reduces it a little bit by tweaking the mathematics of how moving averages are calculated in a clever way. You can find more information about how that's done on Alan Hall's website. In my opinion, this is by far the best type of moving average out there because it has a better balance between noise and smoothness. Just so you can have an idea of the added benefit of using a whole MA instead of a regular SMA, for example, take a look at this chart where we have a 20-period SMA in black and a 20-period HMA in blue. Note how the HMA follows price more closely with less lag and slightly greater smoothness. Here you can see that the whole moving average does a much better job than the simple moving average, assuming we are looking for how the MA responds to changes in price direction. If you're going to use moving average as support and resistance or other applications, you can still use the other types of moving averages without much problem. Take a look at the left side of the chart. Notice how the whole moving average turns much sooner than the simple moving average while maintaining the same degree of smoothness. That represents a reduction in the lag noise trade-off. It's only a reduction though. It's very difficult to eliminate this problem completely. However, if you use the HMA in this way, you will definitely have an edge over the traders who are only looking at the SMA, for example. Secret number 3. Mathematical trick to reduce lag. Beyond the whole moving average, there is another way of reducing the lag noise trade-off of any moving average, and not so many people know about this. This can be accomplished by measuring the rate of change of the moving average being used. The rate of change is simply the inclination of the moving average between 2 points. The trick is that the inclination of the moving average starts to change direction before the moving average does, so it can reduce some of the lag associated with the moving average without increasing the amount of noise. We can combine this property of the rate of change with the whole moving average for optimal results. In some cases, the lag is almost completely reduced, but that is not always the case, of course. If you compare this with the normal simple moving average, you'll notice a significant difference. Even though this is better than using the raw moving averages, it sounds better than what it is in reality, so you still need to filter out the signals using some sort of contextual analysis. The best you can do to reduce the lag noise trade-off in a moving average is to use the whole moving average and measuring the rate of change of it. There is room for discussion about what the optimal periods for these two indicators are. The rate of change captures the deceleration of a moving average, which happens before the MA changes direction. In this chart, we can see two examples where the rate of change of the whole moving average is pointed to the reversal a few candles before the actual moving average. That is the best way of reducing the lag while maintaining the moving average smoothness. In the first example, the rate of change points to a reversal 4 candles earlier than the whole moving average. In the second example, the rate of change points to the reversal 2 candles earlier than the whole moving average. If you ever attempted to trade a moving average reversal strategy before, you know that a few candles can be the difference between a profitable trade and a loss. The trick here is that before every reversal, the moving average gently starts to decrease its inclination to reverse. The rate of change captures precisely this deceleration movement, so it enables the trader to see the reversals a few candles before the moving average turns. This is by far the best way of reducing the lag in a moving average while maintaining an acceptable level of noise. Secret number 4. The moving average angle. Most retail traders look at the direction an MA is going or the crossover of two different MAs. There are more details associated with the moving average. One of these details is the moving average angle. Theoretically speaking, the angle of a moving average is a good measure of the market momentum, and the steeper the angle, the stronger the momentum. That can be used as a confirmation element in a more complicated strategy, and it's a quick way of getting a feel of what's happening. Even though this sounds simple, the MA angle can also be misleading because market momentum changes direction, and the moving average takes a while to catch up with these changes, even when we reduce the lag noise trade-off problem. The result is that the MA might have a strong upward angle, for example, but price action already reversed to the downside. This would obviously be bad for the trader relying on the MA angle for confirmation. In this chart, we can see a good example of how the moving average angle can hint the underlying momentum of the market. When the moving average has a relatively flat angle, it can mean that the market is sideways. When the moving average is in a steeper angle, it can mean that the market has momentum for one of the sides. Perhaps the most important thing about this is that when the MA is relatively flat, it tends to act as a weak support and resistance, meaning that price crosses over the MA without much problem. When the MA has a steep angle, it tends to act as a stronger barrier for price. This is of course not always the case, but it can work as a general guideline. Secret number 5. Moving average as dynamic support and resistance. Moving averages can also be used as a type of dynamic support and resistance. The advantage in doing that is that there is no lag noise trade-off to deal with. Moving averages can act as barriers for price action in the same way that standard support and resistance lines do. This idea represents some different possibilities and also a few problems. The moving averages that will represent stronger barriers are the moving averages that are most commonly used, simply because more people will observe this effect in real time. MAs with 10, 20, and 50 periods are perhaps the most common. That doesn't mean that other MAs with different types and periods will not have the same effect. In fact, they will show a similar effect because for any period and any MA type, there will be groups of traders reacting to them as if they were support and resistance lines. In this chart, we can see a 20 period simple moving average working as a support inside the green box. Notice how the lower tails of those candlesticks touch the moving average. After that, price starts to go up in the same way it would if it had encountered a solid horizontal support line. In the second chart, I plotted an unusual moving averages just so you can see that this dynamic support and resistance property holds with any moving average period. This is a 47 period simple moving average, which is not exactly a popular period for an MA. In the green boxes, we can see how price respected the moving average as support or resistance. In the orange box, we can see price switching the moving average from resistance to support. Secret number 6. Moving averages and volatility. We can get a sense of volatility in a price chart by observing a specific aspect of moving averages. When moving averages with different periods cluster together, it usually means that price is displaying low volatility, and there is a good chance that volatility will start to expand in the near future since it's a cyclical component of price. When several moving averages of different periods pass through one single candlestick, an expansion of volatility usually happens afterwards. In this chart, there are 3 simple moving averages of 10, 20, and 30 periods respectively. These are just arbitrary numbers. Many other combination of periods would work in the exact same way. There are a couple of things to notice in here. When moving averages are clustered together to the point where we cannot tell which one is which, it means that the market is displaying low volatility. And since volatility is a cyclical component, we can expect it to expand in the near future. The other detail is that when moving averages are clustered together like that, they will often pass through one candle like it's highlighted in the red arrows. After the second arrow, volatility starts to expand significantly, and the moving averages start to open again to the point where we can clearly define each one, which is a sign of high volatility. Keep in mind that volatility is much more complex than what I'm suggesting here. This is just a superficial aspect of detecting the changes in volatility using moving averages. Secret number 7. The optimal MA crossover periods. The crossover between 2 moving averages is a common strategy among retail traders, but there are some issues with this approach that many traders are not aware of. The main problem with these strategies is that they assume different market conditions can be traded using the same moving average periods, and that's incorrect. The optimal moving average periods for a trending market are different than the optimal periods for a sideways market. The issue is that a trader never knows what the next market condition will be. The optimal MA periods depend on the size of price vectors, but the size of price vectors vary in an unpredictable way. The trader can only speculate about the future market condition. There are actually easier ways to trade than to guess the optimal moving average periods for any given market condition. If we take a careful look at the price chart, we'll notice that there are price movements of different magnitudes. In my methodology, I call these different sets of movements the major and minor flows of the market. There are specific combinations of moving average that will fit the major flow and specific combinations that will fit the minor flow. There is nothing wrong with the moving average crossover strategy per se. The problem is that the trader never knows the optimal MA periods for the current and future market scenarios, and that renders this strategy obsolete in a way. There's nothing better than a visual example to understand this problem. In this chart, we can observe the crossovers of a 10 period and a 20 period moving averages. In the red box, the market was going sideways, and the crossover strategy was generating terrible buy and sell signals. In the green box, however, the crossover signals were pretty good because the market was trending. The bottom line here is that the trader never truly knows when a sideways market will turn into a trending market and vice versa. We can try to change the moving average periods to make it work in a sideways market, like in this next chart. Here I changed the moving average periods to 5 and 10 instead of 10 and 20. Notice that the crossovers in the sideways mark work a little better, but we also get some false signals in the training part of the chart. This proves that crossover strategies are trickier than a trader might expect. It's not just about observing the crossovers, because that's extremely easy. It's about knowing the next market scenario in advance, and that's really hard to do. As it turns out, the simplicity of observing moving average crossovers is actually a difficult strategy to implement because of this problem. Secret number 8. Candles crossing a moving average. Another popular strategy is to observe when candlesticks cross a moving average. The theory is that when price crosses a moving average to the upside, there is upward market momentum, and when price crosses a moving average to the downside, there is downward market momentum. This is an incredibly simple idea, but once again, we have to pay close attention to several nuances that surround the concept. The MA period and the MA type dramatically affect the result of this type of strategy. Another less obvious problem is that price volatility will also dramatically impact the results. When price gently crosses over the moving averages with low volatility, we tend to have better signals. But when price explodes with volatility, the signals tend to be nastier. The problem with these small volatility explosions is that they will force you to buy when you should be selling and sell when you should be buying. And that's precisely the type of thing that will erode the profits you could have made with the smoother signals. Another potential problematic situation is the market scenario. This sort of thing tends to work less effectively in sideways markets, and it works much better in trending markets. Let's observe an example of that in the chart. In this chart, we can see low volatility transitions in a trending market scenario. Notice how this idea of price action crossing above and below a simple moving average works almost perfectly. Just by looking at a chart like this, you could be tempted to apply this strategy. In the second chart, we have a high volatility sideways market. Notice how the buy and sell signals become extremely unreliable. Once again, the problem is that it's too difficult to anticipate the next type of market scenario. Not only that, it's also pretty difficult to anticipate when the next market scenario is going to start and for how long it's going to last. In summary, price action crossing over moving averages can be part of a valid strategy if you pay attention to the smoothness of the buy and sell signals, the level of market volatility, and the type of market scenario in question. If you attempt to blindly trade the market every time price crosses over a moving average, you will be disappointed in the end. Secret number 9. Moving average for dynamic supply and demand. One aspect of moving averages that is often ignored is its source, meaning the data stream that is used to calculate the moving average. In most cases, MAs are calculated using the closing prices, but there is a wide array of data streams that we can choose from. Using this idea as a starting point, we can add one moving average that is calculated using highs and one moving average that is calculated using lows. The result is that instead of having just one moving average based on closing prices, now we have some sort of band that captures the average of highs and lows. In this chart, we can see an example of that. By tweaking both MA periods for larger values, we can observe that this dynamic channel formed by two moving averages can act as some sort of dynamic supply and demand zone. Once again, the problem of choosing an arbitrary period for the moving averages remains the same. We can never know the optimal periods for each market scenario, and that means we must choose the MA periods arbitrarily. That also means that this property of moving averages will work well in some situations, but it won't work at all in others. In this chart, you can see two moving averages of the same period, but with different sources. One of them has the last 100 highs as the source, and the other has the last 100 lows as the source. The two moving averages combined form a dynamic band that can work as a supply and demand zone in certain situations, like we can observe in the green boxes. Secret number 10. Moving average fan for dynamic support and resistance. Beyond tweaking the source of calculation of moving averages to find dynamic supply and demand zones, we can also play with different moving average periods to create what's called a moving average fan. This simply consists in plotting several MAs with equally spaced periods on the chart. This highlights another property of moving averages working collectively. When the various MAs have a steep angle and are also aligned, they can act as a stronger barrier for price action. However, when the MAs are intertwined, they tend to act as poor barriers. This type of moving average setting is completely useless in sideways markets. There is only something to be extracted out of such configuration when the market is indeed trending strongly. Here we encounter the same problem of not knowing the next market scenario, so we can only really speculate about the optimal MA periods and spacing without any real solid ground to do so. One disadvantage in doing this is that the chart tends to become cluttered and more confusing than what it needs to be. It seems to be a good signal when the trend is really strong though. Secret number 11, the offset fan. The offset fan is an extension of two previous secrets we talked about. Just like we can create a fan of moving average with same offset and equally spaced periods, we can create a fan of moving averages with the same period but with equally spaced offsets. That will create a slightly different effect in the way the moving averages are displayed, and it might yield different opportunities that could not have been observed in other ways. In this chart, there are several 20-period simple moving averages, but each one has a different offset. This creates a different type of moving average fan that can work as some sort of support and resistance track. This can work well in trending markets, but is a terrible idea in sideways markets. There are some important conclusions we can achieve after learning about these moving average secrets. Notice that there is nothing wrong with the moving averages per se. The problem is that the trader never truly knows the optimal moving average period for the current market scenario and for the very next market scenario as well. That's the fact that causes most of the problems associated with moving average trading. Another conclusion is that there are different ways of using moving averages. A trader can follow the MA direction. He can use moving averages as dynamic support and resistance and dynamic supply and demand. It's important to point out that this idea of rate of change is associated with the important notion of the derivative in differential calculus. The derivative is the instantaneous rate of change of a function. However, since price charts are a discrete time series, we are forced to use the average rate of change, but the principle remains the same. These are the secrets about moving average that I learned over many years of trading. It's important that you realize that these are just properties about how moving averages work on a price chart. They are not complete trading strategies. A complete trading strategy requires much more than simple mathematical tricks. If you want to learn how to trade using the best techniques and strategies available, please check out the courses I provide. For beginners to intermediate traders, I offer the Fractal Flow series, which is composed by the Fractal Flow strategy, the Market Maker strategy, and the Newtonian trading strategy. Each one of these will teach you a different approach to trading that is much more sophisticated than simple moving averages. Each of these strategies work on their own, but they can be combined together also. They work on any market and in any time frame that you wish to trade. For intermediate to advanced traders, I offer the Price Action series, which is composed by the heavyweight techniques involving fractal geometry, linear algebra, and very refined contextual market reading to find the most accurate trade entries and exits that are possible to find on a price chart. You can visit my website fractalflowpro.com to see more details about the table of contents of each course and the testimonials from students. I hope you were able to learn something new with this video. If you wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button, share the video, and leave your feedback below in the comment section. Don't forget also to check the other videos in the channel. Thank you very much for watching, and I hope to see you in the next videos. Take care.